You just sold a company for $600 million. More than the GDP of a small island nation. Nobody at the coffee shop knows. Your neighbor who waves every morning doesn't know. Your own mother called last week asking if you need help with rent. Your name isn't on a single headline, not on the paperwork, not even on the building the company operates from. You're not hiding, you're just structured. And that gap between the money existing and anyone knowing you control it is where the real game of wealth lives. Today we're walking through how someone builds a fortune this large while staying completely invisible. Not because it's a fantasy, but because it's architecture. Let's see how the paperwork actually works, and why it was designed this way. You don't start with $600 million. You start with $300 and a filing form. That's what it costs to incorporate an LLC in most states. Wyoming, Delaware, New Mexico all hover around that number. You fill out a one-page form, pay the fee, and suddenly a legal entity exists. It has a name, can sign contracts, open bank accounts, own property, can sue and be sued. But here's the part most people miss. The LLC doesn't have to list you as the owner on any public record. Instead, you name a registered agent. That's a person or service whose only job is to receive legal mail on behalf of the company. In Wyoming, you can use a commercial registered agent service for about $150 a year. Their address goes on the public filing. Your name? Nowhere. To the state, to the public, to anyone searching the business registry, the company is just a name and a P.O. box. You now control an entity, but you're a ghost on paper. This is how it begins. You're not a millionaire yet. You're not even profitable. But you've just created the first layer of separation between you and anything that happens next. That LLC can buy things, sell things, hire people, sign leases, and none of it points back to your personal name unless you choose to reveal it. Most people think business ownership is public. It's not. Not if you structure it right from day one. Which raises the uncomfortable part. Why does any of this matter when you're just starting out? Because the structure you build at $0 is the same structure that protects you at $600 million. The people who wait until they're wealthy to think about this have already left a paper trail a decade long. You can't unring that bell. The invisible ones started invisible. One LLC is useful. A stack of LLCs reporting to a parent holding company is a fortress. Here's how it works. Let's say you start a business, doesn't matter what. Let's say it's a software tool or a service company, or even a boring cash-flowing laundromat chain. That operating business is LLC number one, the one doing the actual work, signing the customer contracts, paying employees. But LLC number one isn't owned by you. It's owned by LLC number two, the holding company. The holding company does nothing except own other companies. It doesn't have customers. It doesn't sell anything. It just sits there, collecting the profits that flow up from the operating business. And who owns the holding company? Sometimes another entity, sometimes a trust, sometimes a combination so layered that even a forensic accountant would need a flowchart and a weekend. You stack them because lawsuits can't climb ladders. Sue the operating business, you hit a wall. The holding company above it? Untouchable. Everything else it owns stays sealed off. Then there's tax efficiency, how income gets reported, where it lands, which jurisdictions see what. Legal structure, the same kind every mid-sized company uses. And the part people miss, opacity. Each layer makes it harder to connect the dots back to a human name. Someone searching hits a dead end at every turn. Let's add some scale. You now own 3 businesses through 3 separate operating LLCs. All 3 are owned by your holding company. From the outside, those 3 businesses look unrelated. Different names, different industries, different addresses. But every dollar of profit flows to the same invisible parent, which you control. You've created a portfolio, and your name still isn't on anything public. To the world, you're nobody. To the bank account, you're the architecture. And here's the part that should bother you. This took 20 minutes to set up. Your neighbor works 60-hour weeks, and his name is on everything he owns. Yours is on nothing. Guess who sleeps better when the lawsuit comes? Here's where it gets genuinely weird. At a certain point, you stop owning things directly, even through LLCs. You move ownership into a trust. A trust is a legal entity that holds assets on behalf of beneficiaries. You can set one up where you're the beneficiary but not the owner. Technically, the trust owns everything. You just benefit from it. Here's the irony. Everyone thinks Cayman Islands. But the real invisibility? A $300 LLC in Wyoming with a P.O. box on Main Street. Better privacy than a $10 million offshore structure, because nobody's looking at Wyoming. Everyone assumes offshore means hidden. Meanwhile, the real money sits in a registered agent office in Cheyenne. Why does this matter? Because if someone searches for assets in your name, a lawsuit, a divorce, a creditor, even just nosy press, they find nothing. You don't own the holding company. The trust does. And the trust is managed by a trustee, which can be another entity or a law firm you've hired. Your name appears nowhere in the ownership chain. You're not hiding assets illegally. You've just separated control from ownership in a way the legal system allows and, frankly, encourages for anyone playing at this level. There's a specific kind called an irrevocable trust. Once you put assets into it, you can't easily take them back out. That sounds insane until you realize it's exactly what old money families have done for generations. The trust owns the wealth. The family benefits from it, but no individual owns it in a way that can be attacked or taxed the way personal assets are. That's how generational wealth stays generational. The structure survives the people. Here's where it gets strange. If you don't own it, how do you control it? Through trustee instructions, voting rights, and beneficiary designations that you write into the trust document when it's created. You're playing a game of legal abstraction, but the control is still yours. And the wildest part? Your ex-spouse's lawyer will never find it. Let's say you've now built or bought several businesses. Your holding structure is humming. Everything rolls up into entities and trusts with your name nowhere visible. But businesses need directors. They need people to sign documents, open bank accounts, appear on filings. So you appoint nominee directors, individuals or services whose entire job is to be the name on the paperwork while you remain the actual decision-maker behind the scenes. This is completely legal. A nominee director is disclosed in agreements between you and them, and they act on your instructions. But to the outside world, to the public registry, they're the face of the company. Honestly, this part bothers me not because it's illegal, but because it's invisible by design. The system allows you to be the decision-maker while someone else is the name on the file. That's not a loophole. That's how it was built. They attend the required meetings. They sign the forms. Your name still doesn't appear. In some jurisdictions, you can appoint a corporate director, another entity acting as the director of your company, creating yet another layer of separation. Let's imagine you've reached 100 million in assets now, spread across a dozen entities. If someone tried to figure out who actually controls it all, they'd find a web of registered agents, nominee directors, holding companies in different states, and maybe a trust or two at the center. It's not a conspiracy. It's just structure. The same structure law firms use. The same structure family offices use. The same structure anyone with significant assets uses once they realize that visibility is a liability. You're not a celebrity. You're not a headline. You don't want to be. You've built something valuable, and you've built it inside a legal architecture designed to keep your name out of the equation. That's not evasion. That's just smart construction. The system allows it because the system was built by people who needed it. So if your name is nowhere on the paperwork, not on the entities, not on the trust documents, not on the public filings, who are you legally? Now let's talk about the moment the number gets real. You've built this structure for years. Maybe it's a portfolio of boring businesses. Maybe it's a single high-value company. Let's say it's worth $600 million and someone wants to buy it. The deal gets announced. The press writes it up. The number goes public. But your name? Still not attached. Here's why. The buyer isn't purchasing assets from you. They're purchasing them from the entities that own them. The sale agreement lists the holding company or the operating entities as the seller. Your lawyer handles the signing. The money flows into the structure, not into your personal checking account. You might be the ultimate beneficiary, but the transaction paperwork doesn't say John Smith sold his company. It says ABC Holdings LLC sold its subsidiary. You stay invisible even at the moment of exit. In early 2026, Netflix reportedly acquired an AI startup for up to $600 million. The company had been built quietly by a small team over a few years. It made headlines because one of the co-founders happened to be a public figure, but structurally, deals at this scale almost always involve entities selling to entities, not individuals selling to individuals. The dollar figure gets announced. The legal entities are disclosed in regulatory filings if required. But the actual humans behind the structure? often invisible unless they choose otherwise. Here's what happens to the money. It lands in the holding company or trust that owned the sold entity. From there, it can be distributed according to the operating agreement or trust terms, maybe to you as a beneficiary, maybe reinvested into other businesses, maybe parked in assets that don't have your name on them either. You've just exited at 9 figures and your neighbor still thinks you freelance from home. Let's be honest about what this is. This isn't a blueprint for you to follow tomorrow. Most people will never operate at this scale. But here's why understanding it matters. The system was designed to let wealth become invisible, and it works exactly as intended. The person with 600 million in assets structured this way pays advisors, lawyers, accountants, and registered agents to maintain the illusion of complexity. It's not hidden in a suitcase. It's hidden in paperwork so boring that nobody bothers to read it. And that's the gap. You look at someone driving a 10-year-old car and assume they're doing fine, maybe comfortable. You don't assume they control a portfolio worth more than a hospital. The ultra-wealthy learned a long time ago that looking unremarkable is cheaper and safer than looking rich. No lawsuits targeting the person with the flashy car. No relatives showing up asking for loans. No press asking questions. Just quiet control executed through entities you'll never hear about. This is also why wealth inequality feels invisible until someone shows you the structure. You can't tax or regulate or even properly measure wealth that's been moved into layers of entities across multiple jurisdictions. It's legal. It's transparent to the lawyers and accountants involved. But it's opaque to everyone else, including the systems trying to track it. That's not an accident. It's a feature. You're not going to build a holding company tomorrow. But now you know why the richest person in your town might be someone you've never noticed. They didn't avoid wealth. They avoided visibility. And the tools to do that cost a few $100 and a decent lawyer. The wealth takes decades. The structure takes a weekend. Here's the part nobody puts in the brochure. You don't need $600 million to benefit from understanding this. You just need to know that wealth and visibility are not the same thing. The person who looks rich often isn't. The person who is rich often looks like nobody. This isn't advice. I'm not telling you to set up shell companies or trusts. I'm telling you that the people who do set them up did it long before they needed to, because the structure protects the wealth, not the other way around. By the time you're wealthy enough to want privacy, you've already left a trail. The invisible ones started invisible. And if you're wondering why this matters when you're not building an empire, here's why. The system lets this happen. The laws were written to allow it. The offshore jurisdictions, the anonymous LLCs, the nominee structures, none of it is a loophole. It's the design. And until you see the design, you can't understand why the gap between you and them keeps getting wider even when you're doing everything you're told to do. The person with 600 million in a holding structure you'll never see isn't smarter than you. They're not working harder. They just know which forms to file and which names to leave off of them. That's it. That's the entire mechanism. Boring paperwork, executed correctly, maintained quietly. No headlines, no flexing, just structure. If this is the first time you've seen how wealth actually hides in plain sight, you just learned something most people never will. That's worth subscribing for. We're not here to sell you courses or hype. We're here to show you the mechanisms the system doesn't advertise. Next video breaks down another one. You've already started seeing the pattern. That's money, actually,